If you've heard about options, you've probably heard about the wheel strategy. There are plenty of videos out there. It's considered one of the best strategies for beginners. It's simple yet effective, providing somewhat decent and consistent returns. Some even call it the holy grail of options trading. But is it really? In this video, I will put this strategy to the test. I'll trade it in real time, going through all the steps, sharing my thoughts on it, and most importantly, how much money I end up making or losing. As you probably know, the wheel strategy consists of three parts: selling cash secure puts, getting assigned and owning the stock, and selling covered calls. Let's start with selling a cash secure put. To do this, we need to choose a stock that we're comfortable holding for a long time, or one we expect to stay neutral or be bullish in the near future. For me, Marvell fits this bill perfectly. Not the comic book Marvel, but the Marvell Technology, a company specializing in developing and producing semiconductors. With the ongoing AI craze, I anticipate this company will see a stock price increase, particularly around their earnings report, which is due in about 2 months. Therefore, I can sell weekly cash secure puts with confidence until then, because even if I get a sign, I can simply hold the stock, and I'm 90% sure that the stock will spike in price around earnings, allowing me to sell it for a profit. Alright, so here we have the option chain for Marvell. Let's take a look at the puts section. As you remember, we want to sell a put here. Depending on the broker you're using, you might have a different layout. I know on some apps you have to switch between the buy and sell tab. In my case, the premium for selling puts is displayed in the middle row. So the stock is currently trading at around $73 per share. And I'm going to sell a put at the 70 strike that will expire in 10 days. When choosing your strike prices, it depends on how aggressive you want to be. If you choose a strike price closer to the share price, you will receive more credit, but you are at higher risk of getting a sign if the share price drops below your strike at expiration. Conversely, if you want to play it safer, you would move further away from the current share price, but you will receive less credit. For the simplicity of this video, I will choose a round number, so the 70 strike is perfect. And for that, I will receive, let's see here, $150 in credit. A very important note here, each option contract controls 100 shares. So to be able to place such a trade, I need to have the required capital to buy 100 shares at $70 per share, which amounts to $7,000. I know, right? This is one of the drawbacks of the wheel strategy. You need a lot of capital to begin with, although if you're trading with margin, that's a different story. But going back to my trade, as long as the stock stays above $70 per share, this put option will lose value each day until expiration, which is 10 days from now, next Friday. All that is left to do now is wait until then, so I will see you in a couple of days. Good afternoon. With 3 days left until expiration, I wanted to give you an update on my trade. The stock has remained relatively flat, and as expected, my cash secure put has lost some value. It is now worth about $100, which means I could close it now for a profit. As you remember, I received 150 as credit, and if I pay back 100 to close it, I'll net a $50 profit. However, I'm going to hold on to this position until Friday to squeeze out the maximum credit. I just wanted to let you know that you don't have to wait until expiration. If you've hit your profit target, you can close the trade and lock in on your gains. Hello again, it's finally Friday, and there's just one more hour until the market closes. The stock is trading at $70.40 per share, which is close but still above my strike price of $70. This means my put option is out of the money, and since it will expire today after the market closes, it doesn't hold too much value. In fact, it's currently worth only $2. To get the remaining 2 and achieve the maximum profit of $150 from this trade, I'll need to wait for the market to close. By the way, you don't have to take any action in this situation. Your broker will automatically close this option for you. However, given that the share price is very close to the strike price and it could drop below it at any moment, the best course of action is to either close it or roll over the option to avoid a potential assignment. And I'm going to do that right now. Thinkorswim makes this process very easy with the one-click rollover feature. Rolling over just means closing the current cash seeker put and opening a new one with a different expiration date. Okay, I actually want to change my strike price, so I'm going to click Add Option Leg. Here I have the choice to select the highest strike if I have a bullish outlook, which will give me more credit, or a lower strike for less credit but a better position if the stock starts to fall. Interesting. I think next week the stock will trade in the mid 60s, but I actually want to get assigned, so I'm not going too far, and that is why I'm choosing the 69 strike. Also because I have a shirt with the number 69. What? You don't believe me? Just hang on a second. Huh? How about this? This is my lucky shirt. Although I've never actually gotten lucky while wearing it, so yeah, lucky me. Right, so the cash seeker put. So this rollover will give me a credit of $100, and if I add that to my previous 150 credit, I am now up to $250. Looking very rich right now, not gonna lie. So I'll place this order, and there it is. So now we just have to wait and see how this plays out. Today is Friday, exactly 1 week from my previous update, and it looks like my 69 put will expire in the money because the stock is currently trading at $63.30. Oof, that kind of stinks. With only a few hours until market closes, I don't think the stock will rise back up, so it's very likely that I will get assigned. Just a side note here again, the broker will handle this automatically, and in my case it will buy 100 shares at $69 per share. That is why you need to have the required capital before selling a cash seeker put. Of course, I could avoid the assignment by closing this cash seeker put before the market closes, but I would have to pay its current value of $572. Even after subtracting the credit I initially received when selling the puts, I would still be at a loss. So it doesn't really make sense to close the position. Moreover, I do want to get assigned, as I mentioned, and I feel very comfortable owning the stock at $69 per share. Oh yes, today is Saturday and the markets are closed, but I wanted to show you that I indeed got assigned. As you can see, it shows I have an unrealized loss of $675, which is exactly the difference between my purchase price of $69 and the current price per share of $62.25. And now that we own 100 shares, we can turn the wheel and start selling covered calls. Since I bought the shares at 69, it makes sense to sell a covered call at the same strike price. However, there is a problem. Because the share price has dropped significantly, I cannot collect much premium for the 69 strike. For the closest expiration date, I can only get $13 in credit. All I can do now is wait for the stock to rise back up, which will also increase the premiums for covered calls. This situation highlights another drawback for the wheel strategy. If the stock drops too far from your buy-in price, you won't be able to sell covered calls for a decent credit. You haven't necessarily lost, but your capital is tied up and you have to wait for the stock to recover. Hopefully, in my case, this will happen in the next few days, so I'll see you then. Alright, a couple of days have passed and the stock has slightly recovered. It is now trading at $66.60. And is a perfect time to sell a covered call. Looking at the option chain, it seems we can collect $93 for the 69 strike. However, I'm going to go slightly bullish and sell a covered call at the 71 strike, collecting a credit of $50. The reason for this is that if the share price rises and closes above 71 per share at expiration, my shares will be sold automatically by the broker and I will realize a 200 capital profit gain because I bought the shares at 69 and sold them at 71, plus the 50 premium I just collected by placing this trade. So I'm looking at the $250 profit, And let's not forget the 250 that I collected from selling those cash secure puts. There is, however, another drawback here. If the share price increases significantly, say it trades at $80 per share, I would still be obligated to sell my shares at 71. While I haven't necessarily lost, I would miss out on additional capital gains. Of course, if the share price closes below 71, I would keep my 100 shares and can continue selling covered calls for more credit until they are eventually called away. Okay, so my overall thoughts about the wheel strategy are neutral. Like any other strategy, it has its pros and cons. I'll let you be the judge for it, and hopefully you can find your own way through it. That is it from me. Good luck on your trades, and I'll see you next time.